Hello, and welcome to our third quarter strategy review for 2024. We met on June 17th, and with me at the meeting was Lynn Skina, Vice President and CEO of the firm, Bob Toomey, Vice President and Director of Research, also Scott Schill, who is the Director of Law and Planning, and also David Hooper, who has joined us before. He is a outside investment manager. Our special guest, however, was Carlin Patel. Carlin is a vice president and investment strategist at State Street in their ETF area, and he was extremely helpful in going through all of the things that we had to deal with at this session, which included, as we'll cover as we go along, new all-time highs in some areas of the markets, continued activity in the high-tech and AI areas, and also concerns from the Federal Reserve as to whether there would be a decline in interest rates or not. So with all of that background, again, it was a very interesting and extended session. And to begin, I'd like to toss it to Bob to talk about equities.
Thanks a lot, Stan. So I would say, yes, it's been one of our more exciting meetings, if you will. It was great having Carlin there. I think he provided, an excellent background and lots of things we discussed relating to the overall market outlook and different sectors of that market, and also factors that I think are important in investment strategy, both on the equity and fixed income side. But as far as it goes relating to U.S. equities, I think that, as you know, or if you keep an eye on the market, you'll know that the U.S. stock market, as reflected in the S&P 500, is at a record high. It's been achieving record highs now for several weeks. This has been driven largely by euphoria around artificial intelligence, how it affects various companies that have exposure to that or business in that. And it's been driving up the valuations of many of the large cap tech stocks. I think another reason for the record highs in stocks has to do with, investor optimism about corporate profits, which are improving. But we do have a problem right now, and the problem is valuation. Valuation is definitely on the high end. It's being driven of greater concern. It's being driven by a narrow group of stocks, namely a handful of large cap tech stocks. We believe this is raising the overall risk profile of the market, and we feel it's important to manage and mitigate this risk. So as part of the meeting, one of our decisions was to actually reduce slightly our exposure to U.S. equities. We reduced it by about 8%. We're now slightly tactically underweight U.S. equities. We still believe that rising earnings, Fed policy, and lower inflation will continue to support a positive backdrop for stocks, but we think that it's being increasingly tempered. Our outlook is being increasingly tempered by rising valuations and some of the white hot performance in some of these tech stocks. It's a little reminiscent of other major peaks such as 1973, 2000, and 2009. So at any rate, we felt it was prudent to cut back equity exposure a little bit. I would like to now turn this over to Len to talk a little bit about fixed income.
Thank you, Bob. Inflation has come down significantly from its peak in 2022. Despite that, it remains above the Federal Reserve's inflation target of between 2 and 3%. This has caused the Fed to keep interest rates higher for longer than originally anticipated. We do expect the Fed to lower interest rates 1 or 2 times over the second half of this year, which has led us to adjust our bond portfolio. Overall, we increased our allocation to fixed income across the board, with the greatest increase coming in the intermediate term area. We also adjusted two of the funds that we have used to supplement our fixed income allocation. We removed the Illyrian MLP holding from our long-term bond portfolio, where it has done quite well for you since we added it. And in the intermediate term holdings, we replaced the utilities ETF that we've used as a bond surrogate, and we've replaced that with a senior loan ETF. The senior loan ETF holds loan instruments between banks, and it should result in reduced volatility and increased yield. With that, Stan will now talk about REITs.
Thanks, Len. REITs have always been a good portion of our portfolio, although recently REITs have not been performing that well. We did decide to get rid of our holdings in the home builder section and concentrate more on the REITs themselves, which of course, remember, must pass through 90% of their dividends, and those distributions represent a good add to our dividend portion of our portfolio. So with that in mind, again, we did maintain a reasonable exposure, but down a little bit in REITs for this quarter. But again, we still do favor the distributions, and we're looking forward to those possibly even increasing as we look at the rest of the fixed income market and the interest rates that are, out in the marketplace right now. So with that, I'd like to turn it back over to Len to talk about the international markets.
Thank you, Stan. The major developed nations in Europe are experiencing lower inflation and have more attractive stock valuations than US equities. For this reason, we have moved from underweighting international equities to a normal weighting of them, which is now higher on a relative basis than our underweight from normal on US equities. We have maintained the high dividend international fund that we've used for a while to represent a portion of the international portfolio, still responding favorably to the higher yield that fund will contribute. With that, here's Bob to talk about other changes in our holdings.
Thanks a lot, Len. So both Stan and Len talked a little bit about some of the changes that we saw in REITs and fixed income. We spend quite a bit of time really at our meetings and looking at opportunities, usually in ETFs, that we seek to enhance the overall performance in a given asset class. And I think it's an important part of the work that we do for you as our clients in managing your capital. With regard to changes in US large cap equities, we continue to hold both the S&P index as well as the COWS ETF, which is the Pacer large cap cash cows ETF. These are large companies that generate a very high level of free cash flow. We think that we actually spent a lot of time at the meeting discussing this particular holding, and we kept it because we feel that it presents a good balance to the S&P 500 that is heavily overweighted in technology. And at some point, those tech stocks are going to correct. It's only a matter of time. And we think that COWS provides a good balancing exposure that we think should show relative outperformance in an environment in which those tech stocks are correcting. With regard to the home builders, as Stan mentioned, we eliminated the position in the SPDR home building index, primarily to focus on yield. Our core holding in that area, the USRT, has a very nice dividend yield, and this also, by eliminating XHB, actually enhances the income in your portfolio. I would finally mention the senior loan ETF that Len discussed. We spent some time looking at different opportunities in the intermediate bond area. This particular ETF, the Spider Senior Loan ETF, has a 9% yield. So it really enhances the overall yield profile of the bonds you own, while actually offering a more attractive risk-adjusted yield. This particular ETF has very low volatility over time, much lower than utility stocks and even intermediate treasuries. So with that, I'm going to turn it over to Scott, who heads up our longevity planning business, and he's going to talk a little bit about what you should do if you see a loved one having difficulty with money or managing money. Scott, I'll turn it over to you.
Hey, thanks, Bob. You know, we deal with multi-generations of clients, and it's not uncommon that people ask us, hey, I noticed that there's some odd purchases going on with my parents, or there's some unpaid bills, or where do we go? What do we do? How do we start? And one of the unique things that we do is we really can support families in this journey. So I wanted to talk a little bit about some powerful tools that we have, and then give some practical advice. So the basic fundamental tool is called a power of attorney. And what is a power of attorney? A power of attorney is a document that allows a trusted person, usually a loved one, to step up into the shoes of the person that is the principal. And what does durable mean? You hear that word durable, power of attorney. Durable means that it remains in effect even if the principal becomes incapacitated. So we have some really unique tools, because you don't want to just give power. You really want to make it a manual of instructions to support getting the outcomes that we want. But I wanted to talk today about some practical steps. What do we do actually in that situation? So if you notice something going on with a loved one that concerns you, some things we can do to lower the risk of financial abuse or fraud are things. I'm going to give you 7 of them. Number 1 is you can agree to spending limits on credit cards. That's where a lot of the money starts going out the door. Number 2 is, especially if you're a power of attorney with the right kinds of powers given to you, then we can create a separate account for recreational spending. And that avoids the risk of everything being taken by a bad actor or a creditor or a predator. We want to set up auto pay bills. We want to set up automatic notifications of withdrawals or large changes, so that if something is going on, you have early and timely awareness of it and can jump in. The agent should be requesting copies of bank and credit card statements so we can make sure that we're monitoring those things. Sign up for the Do Not Call list at donotcall.gov. That's a government-sponsored website. Ask credit card companies to stop sending balance transfer checks. So if we can put these basic tools in place, we can both get ahead of and protect our loved ones in this way. So that's a piece of what longevity planning is. It's very practical on how we make sure that our families are successful as in retirement. With that, I'm going to send it back to Stan.
Thanks, Scott, and appreciate those comments. And I hope that you are all recognizing now that we're expanding a little bit, not just talk about investing, but expanding to talk about more of the legal things that you need to be aware of. We're very happy to have Scott with us, and more importantly, to have him share some of that information with you. So thank you very much, Scott. And as far as you're concerned, we can probably expect to hear from him again in future quarterly reviews. Looking at the session today, as you could probably hear, there's been kind of a consistent theme of being a little bit more conservative and also making sure that we are picking up as much as we can in terms of dividend and interest returns. these definitely go towards reducing the volatility of your portfolio, because these are numbers that will come in on a monthly or quarterly basis and add to the return of your portfolio. So that's where we are at this juncture. Remember, each quarter we do look at things that we think will not happen, but if they do, we want to make sure that we don't miss taking a change that might be necessary and making that decision again at the end of the quarterly session, rather than when we're right in the middle of it. So this quarter, what are our triggers? If you listen closely last quarter, I can tell you they're exactly the same. We have the same concerns. Number one, we're definitely concerned about CPI, Consumer Price Index. That's driving a lot of areas, especially as has to do with the Federal Reserve and interest rates, et cetera. So again, these are numbers we do not expect to achieve. Remember that the Federal Reserve is looking to have CPI get back down to 2%. Frankly, we doubt if they can accomplish that, but we did say if they could bring the average CPI monthly down below 2.75, that would cause us to take some positive action. On the opposite side of that, we're concerned if CPI was to raise substantially, and what we're looking at there is a number above 0.85 per month. That would be like a 10% CPI. So if we saw that, that would cause us to take some negative action. And lastly, the unemployment number is something that we also want to keep an eye on. If we do see that go above 5%, that would cause us to take some negative action as well. So with that, again, I think it's been a relatively long session. Thank you very much for tuning in, and we hope to see you again next quarter.